So I wanted to welcome everyone to our presentation called Understanding Pensions in Canada. My name is Alexei Schwartzman, and I will be telling you a little bit the way Canada or Canadian financial system works. And there are a number of things that we will be covering today. And just before we start, a quick disclaimer. This presentation is for general financial purposes only. This is not investment advice. This is not financial planning advice. This is not tax advice. I have a number of companies that I work with. On the mutual funds, we're licensed with Investia Financial Services. On the insurance side, we're licensed with many different companies. And of course, every time I do a presentation, I have to do a disclaimer like that. So what is our journey over the next few minutes? What we'll do is we'll talk about 3 different kinds of pensions that we have, that you have access to in Canada. And we'll talk about public pensions, we'll talk about private pensions, we'll talk about workplace pensions. We'll talk a little bit about retirement planning. And there will be, I usually leave the Q&A session to the end, but if you run into any questions, by all means, feel free to use the chat window. I hope all of you can see the chat window. And if you have, so if you have any questions, stop me, ask. I'm more than happy to address them throughout our presentation. The first question I usually ask when we talk about, even before we jump into pensions, one question I'll always ask is, have you thought about your retirement? Because the definition of retirement, of course, is very different depending on every individual, on their family, on their situation. So one thing when it comes to retirement, when it comes to understanding pensions, it's not so much the question of, well, which pension is going to get me to my retirement? It's more of a question, well, what is my retirement going to look like? And that is an important question because the strategy that you're going to pursue is going to depend on what is your pension going to look like. And for some people on the call, your pension could be 30 years down the road, maybe even 40, maybe 20. Ultimately, it doesn't matter. The question is, what do you want to see in your retirement? I did like this definition of the word retired. I was tired yesterday, and I am tired again today. Hopefully, that is not where most people stand. Now, the 3 pillars of retirement, as I mentioned, so there are public pensions, there are private pensions, and there are workplace pensions. If you give me a second, we have one more person who is joining. Excellent. And what we will be doing is we are going to be covering in quite a bit of detail the different kinds of pensions that exist and how you can use those to your advantage in order to secure your retirement. First and foremost, or the most important ones, arguably, actually maybe not the most important one, but the most obvious one, is a government or public pension. In Canada, there are 2. On the slide, you see 3, but they're mostly 2. And the ones that you will see and hear a lot, one of them is Canada Pension Plan, CPP. One of them is Old Age Security. So those are the 2 key public pensions that we have in Canada. Now, a little bit about each one. Canada Pension Plans, so those of you who are employed, I'm sure you have noticed on your pay stub or on your T4, there is a portion of your paycheck that goes into CPP. CPP is Canada Pension Plan. The best way to describe CPP is, imagine there is a big bank account or a big piggy bank. And every day that you work or every paycheck that you get, there is a portion that goes into this piggy bank. And then this money in this piggy bank grows, and then when you retire, then you can start taking money out of this account, out of this piggy bank, in order for you to live comfortably. That's how it works. There's a certain percentage that is held back by your employer from every paycheck, and your employer would be matching your CPP contributions. So instead of you contributing, by the way, another contribution, it's it hovers around 5%, let's just say. So 5% of your paycheck goes to Service Canada. A match of this amount is contributed by the employer into a Service Canada account. And then when you retire, money comes out of this account. That's one of your pensions. That's CPP. Old age security is a little bit different. Old age security is a pension that you don't actually have to work for or to receive. The way old age security works is if you live in Canada, you get old age security. So sometimes people who come to Canada, they come much later. So maybe they're already retired. Maybe people come at the age of 55 or 60 or 70, etc. And they may have not contributed anything to Canada pension plan, but as long as you live in Canada, you get old age security. And the way it works, by the way, in order to get the maximum old age security, you need to live in Canada for 40 years. So if you don't live in Canada for 40 years, then you won't get the full amount. The GIS, I specifically left GIS off the two main pensions. And the GIS is the Guaranteed Income Supplement. So Guaranteed Income Supplement is basically given to you by the government, not to you, given to an individual by the government if the individual meets a certain criteria. For instance, low income. So individuals who are considered to be low income, and there are different definitions of low income, they might be entitled to the Guaranteed Income Supplement. I usually don't include it because if you do your financial planning right, you won't need it, and you would be more than happy to share it with other individuals. This is how the numbers work. So if you were retiring today, let's say you're at the age of 65 today, and let's just say you earned full CPP. Okay, we'll come back to the full CPP definition in a minute. So you would be entitled to receiving $1,400, $1,433 from CPP. That's the maximum amount. But just because that's the maximum amount, it doesn't mean that you're going to be receiving that amount. So most people don't actually get 1433. On average, people get about 845. How do you get full CPP? Your full CPP depends on how much did you contribute. How much you contributed depends on what is your income. So in Canada, in 2025, if your income is about 65,000, I don't remember the exact numbers, but about 65,000 or over, then you would have contributed maximum CPP. So imagine when you retire, and basically the way CPP formula works is when a person retires, Service Canada looks at the last, let's say, 15 years or the best 15 years of person's contribution. So the question is, during those 15 years, did the person contributed the maximum amount to CPP? Alternatively, the question is, if the person contributed to CPP, so what was their income? So if somebody's income in the last, let's say, 15 years of their work is more than 65,000 Canadian dollars, then they would have maxed out their CPP. And if they max out their CPP, then they would be entitled to the maximum contribution. That's how CPP works. Like I said, on average, people receive much less CPP than the maximum amount. Why? Because not everybody earns more than $65,000 a year. So therefore, imagine somebody earns $30,000, and if somebody earns $30,000 a year, then instead of receiving the maximum CPP, they'd be receiving roughly half of CPP. Now, let's switch to old age security. So the maximum amount for old age security is $735. By the way, it's the maximum amount if you are retiring today and if you are at the age of 65 today. I'll elaborate a little bit more on those. But the maximum amount, and as I've mentioned before, if you live in Canada for 40 years, you would be receiving $735 a month from CPP, from old age security. If it so happens that today you received or you lived in Canada for 20 years, then you would be entitled to half of that amount. So between these two, you're looking at about $2,100. That's the best case. If you lived in Canada for more than 40 years and if you've maxed out your CPP contributions, you'd be looking at about $2,100 of pension from the government every month. Okay. Now, a couple of important caveats. Caveat number one, both CPP and old age security and a few other pensions, by the way, including guaranteed income supplement, they are adjusted for inflation. So as inflation goes up every quarter, this $2,000 or $2,100 per month will go up a little bit depending on the inflation. The higher the inflation, the higher is the rate at which CPP and OAS get adjusted. The other factor that influences how much CPP or old age security you would be receiving depends on when you take it. And this is a very important component. I should mention that if a person qualifies for the guaranteed income supplement, then they would, the GIS amount is about $1,000 a month. And I believe in order for somebody to qualify for GIS, their income would need to be about $22,000. And a perfect example is, so imagine there is a senior who only has, let's say, CPP. Maybe they don't have old age security, or maybe they have a little bit of old age security, but it's not enough. So if their combined income for the year is less than $22,000, then they may be entitled to GIS. When I say may be entitled, because there are other factors. Does this person have a spouse? Is the spouse retired? What is the spouse's income? So there are a number of factors that influence whether or not the person would be receiving GIS. But the best way to think about it is, if you have seniors who are low income, or in this particular case, low income means $22,000 or less, then in addition to their CPP and OAS, they would be receiving about $1,000 a month from guaranteed income supplement. If somebody wanted to earn more CPP or old age security, can they? And the answer is yes, they can. With CPP, I mean, keep in mind, there's not much you can do in terms of the actual CPP amount, because CPP depends on how much you've contributed while working. With old age security, there's not much you can do because it's based on how many years. You can't go, you don't have a time machine to move to Canada sooner so that you live in Canada for longer. But what you can do is you have an option of when to take old age security and CPP. Okay, what do I mean by this? These numbers are based on they're based on the person's retirement age of 65. So the month the person turns 65, by the way, you can apply for these like 6 months prior or a year prior. But when you fill out the application for both CPP and OAS, you indicate when do you want to receive it. So if you want to receive it the month when you turn 65, these are the numbers. Okay. If you want to receive it later, you actually get more. And the way it works is you get extra 0.6% for every month that you delay taking CPP. You get extra 0.6% for OAS, 0.7% per month for CPP, which basically means, imagine you do not take your CPP and old age security at 65. Imagine you hold off as much as you can. The maximum you can hold off is up until the age of 70. So if you take the same CPP and old age security, not at 65, but at 70, you would get a 42% increase on your CPP amount. You would get a 36% increase on your OAS. So now you're looking at about $3,000 a month. Once again, adjusted for inflation. So oftentimes the question is, now I'll switch to financial planning, because as a financial planner, sometimes people ask, should I take my CPP at 65 or should I delay? And it's not a black and white answer, because everybody's story is a little bit different, but there are options. And if an individual doesn't need their CPP OAS at 65, delay. And oftentimes, by the way, there are calculations to look at, well, when should you take it? It's not, yes, we have certain ways to figure out what would be better. Should you take it at 65? Should you take it at 60? Should you take it at 70? But it's not a black and white situation. There are some factors that will affect your decision. I should also mention that you could, not you, but the individual could take CPP earlier than 65. A person could potentially go as early as 60 years of age to take CPP, not old age security, because that one kicks in at 65. But for CPP, the person could. And every month that the person takes CPP earlier, they get a decrease in terms of the amount of how much CPP they would receive. So typically, it's not something that we recommend unless the individual really needs the money. And even then, ultimately, you do try to avoid it if you can. Now, that is, or those were the public pension options. We're now switching to the private pension options. And if you have any questions about anything I've mentioned on the public side, let me know. Feel free to put it in the chat. And I will be addressing those maybe at the end of the webinar or maybe throughout. In the meantime, let's move into your private pension. And there are several of them. Your private pension, so by default, pretty much everybody on the call has heard of RRSP. RRSP, we'll talk a little bit more about it. RRSP or RRIF, we'll talk about that as well. There's also something called a LIRA and a LIF. There is a TFSA account, tax-free savings account. Hopefully all of you or many of you are using it because that could be part of your private pension. That's just a tax-free savings account where you put money and it grows tax-free. For other individuals, once you max out your tax-free savings account, you could be just compiling money in the savings accounts or other types of investments. For many individuals, real estate becomes your personal/private pension. When I say real estate, oftentimes, if you were to buy a rental property, then when you retire, you sell the rental property, you now have money to supplement your retirement lifestyle. And there are a couple of other options. But the biggest, the most important one is an RRSP. And I don't know how many of you on the call, and by the way, feel free to put the answers in the chat if you'd like. And the question is, how many of you have an RRSP already? If you do, fantastic. If you don't, potentially that is something that you will benefit from. I would expect that many, if not most of you, would have an RRSP. If you want to put it in the chat window, great. If not, no problem. Ultimately, the best private pension is an RRSP. What's an RRSP? RRSP is an account. It's basically an account. RRSP stands for Registered Retirement Savings Plan. This is an account that you can set up with a bank, with an investment firm, with Questrade, Wealthsimple, doesn't matter, RBC, BMO, they all, or we all as financial planners, we all have access to RRSPs. What is that? It's an account. When you put money into this account, it works as a deduction on your taxes. What does that mean? It lowers your income. Okay, so imagine your income is $50,000. You take $10,000, you put it into an RRSP. So effectively, from a tax perspective, your income is no longer $50,000; it's now $40,000. Okay, but if you were working for a Canadian employer, they would be holding back enough tax, assuming $50,000 of income. Therefore, if your income is $40,000, that means you get some of the tax back. That's why a lot of people who put money into an RRSP get a refund. Some of you on the call may have a group RRSP. So a group RRSP, this is when you have your plan, your RRSP plan through your employer. So your employer can hold back a part of your paycheck, put it into your RRSP account, and then oftentimes they would take some of their own money and they could match it, or they could put some extra amount. Typically, we see matches, so 1-to-1, $1 from the employer, 1 from the employee. With some cases, your employer can give you more than one. It could be 2-to-1. I've seen 3-to-1. I've seen 7-to-1. Rare, but it does happen. And ultimately, in your RRSP, the money gets invested, and you do not pay taxes on the growth. So whatever the growth you have in your RRSP account, you don't pay taxes on it up until you decide to use your pension. When do you decide to use your pension? Well, technically, it's up to you. You have to start using it at the age of 71. And the way it works is RRSP, like I said, it's a registered retirement savings plan. When you turn 71, or at some age before, could be 65, could be 60, could be 55, it doesn't matter, you can convert your RRSP into a RRIF. What's a RRIF? RRIF stands for Registered Retirement Income Fund. It is also a tax-sheltered account, which means you don't pay taxes on the growth of it. Okay, but the difference is when you have a RRIF, or when you start using your RRSP, you have to start withdrawing a certain amount of money from your RRSP. So imagine you are now 65 and you have $100,000 in your RRSP account, and you tell the financial institution, hey, I would like to start using this money, I'd like to retire. So what the financial institution will do is they will convert your RRSP into a RRIF, and you will now start drawing a certain percentage of your money as part of your pension or as part of your retirement income. So at the age of 65, it's 4%, at the age of 70, it's 5%, and then it slowly increases. Okay. A lot of people start taking their RIF or convert RSP into RIF at the age of 65, but you don't have to. Like I said, you can go as early as 55 or even before. There is actually, you can take it at 40 if you wanted to, but it doesn't really make a lot of sense. And then as you get older, the percentage that you have to take from a RIF increases. And as you can see, once a person gets into their 90s, now every year you're taking 13%, 15%, up to 20%. Once you're in your mid-90s, you start going 20%. Why? Ultimately, CRA doesn't really want you to pass away with a lot of money in an RSP. They want you to withdraw it, all of it. So that's the idea. When you have an RSP, you convert it into RIF, and you start receiving money from your RIF. How much you receive depends on your age. So as you age, the percentage increases a little bit. And the growth of your RSP account depends on how it's invested, right? So you can have fairly volatile or aggressive investments, or you can have very stable investments, such as, let's say, GICs or bank accounts. And ultimately, how much you withdraw versus how much your RSP grows depends on a number of factors, including what's your investing strategy. So that's your private pension. I did want to mention a workplace pension. So for those of you who are lucky enough to have a group RSP, those are wonderful. And I certainly hope that each person on the call that is or that has a group RSP, that you maximize the percentage that you're putting into it that gets matched by the employer. So if the employer says, listen, we're going to match up to 3%, 4%, 5%, we typically see around 4%. I do see 5% very rarely. Usually it's 4% because of certain rules, which we don't need to go into. But if your employer matches whatever you contribute from your paycheck, maximize it. So whatever the maximum is, go for it. If you want to do more, great, but make sure that you get as much as you can. Some of you, and I don't know, we could run a poll, but some of you might have a corporate or workplace pensions. And typically these fall into two categories. So there is the defined contribution and defined benefit pensions that you can get through work. In a minute, we'll spend a little bit of time talking about the difference between the defined contribution and defined benefits plan. Some of you might have deferred profit sharing plans. So those of you who work for tech companies, so Amazon, Meta, Microsoft, we do see, or a lot of tech firms, especially in Vancouver or in BC. So profit sharing becomes something that we see quite a bit. What's the deferred profit sharing plan? It basically means at the end of the year, the company looks at how did it do financially. And the company can basically say, hey, we have extra profits. We're going to take some of these extra profits and we're going to give it to our employees. What do the employees have to do? Nothing. It's basically the company says, listen, we're going to put whatever, 1,000, 5,000, 10,000, 100,000 into a DPSP, deferred profit sharing plan. And there are certain restrictions, there are certain rules, there are certain criteria, requirements. When can the person access these amounts? But ultimately, this is really nice from a company. The money also grows tax sheltered. By the way, oftentimes the company, when they give the employee some of their profits, they give it as shares. So for instance, we do see this with let's say tech companies. So instead of Amazon giving you $1,000, they might give you $1,000 worth of Amazon shares, and the shares stay in a deferred profit sharing plan. You don't pay taxes on the growth, but then when you take the money out, there may be some taxable implications for that. The biggest three examples of the workplace pension, so group RSP and these two plans, so defined contribution or defined benefits plans. Defined benefit versus defined contribution plans, there are a number of differences. And I don't know if any of you belong to either, Generally, defined benefit plans, and we'll talk about these in a minute in more detail, but defined benefit plans, you will see them. So if you work, let's say, if you're a member of the police force, member of, if you work for the fire department, if you work for a hospital, no. If you work for the government, so oftentimes government positions are defined benefit, okay? But in the industry, we are seeing a switch. So there are very few defined benefit plans now. Everybody's switching to defined contributions. And what are the differences? So defined benefit, your employer basically says, listen, if you are, let's say, and I'm picking on police officers because I think they used to have, I don't know if they have the defined benefit plans, but they used to. So it used to work like this. Hey, if you're a police officer, you are guaranteed a pension, and your pension is going to work as follows. We're going to look at, let's say, the last 5 years of your income working for the police force. We're going to multiply it by a certain amount, and that's the amount that you're going to receive for the foreseeable future, oftentimes adjusted for inflation. Not always, but oftentimes. Okay. Defined contribution plans basically says, when you retire, you're going to get a certain pension. We don't know what that pension is going to be, but you are going to put money, you're going to contribute into this plan. And when you retire, whatever you've accumulated, plus a few criteria, rules, etc., that is the amount you're going to receive. So with payout certainty, when you have a defined contribution plan, you don't know how much you're going to get. Defined benefit, you do. There is a formula for defined benefit plans. With defined contribution plans, no. If you planned it particularly well from an investment perspective, fantastic. If not, well, so be it, you are out of luck. The risk for the investments sits on the employer for the defined benefit plans. So if you are a police officer and a plan told you that we're going to give you X number of dollars, by law, they have to give you X number of dollars, regardless of the kind of performance you are getting on the investment, on your investments. So in certain situations, and that's, by the way, that's the problem we've run into, I think, in about 2008, 2009, where investment returns were really low. But if a company guarantees you certain pensions, they are on the hook. And I think they had a problem in the States, and in Chicago, for instance, or the state of Illinois. They had a lot of people retiring, and the pension plan didn't have enough money to pay all these people simply because they had guaranteed pensions. So you start running into problems. The investment risk falls onto the employee for defined contribution. So that's why we're seeing the switch towards defined contribution plans. And both, so with defined benefits plans, they cover for a certain period of time, usually a lifetime. With defined contributions, once you run out of money, well, you run out of money. That's your problem. Defined benefits are index protected. Defined contributions usually are not. And there are a couple of other differences. So for instance, defined contribution plan, you can, so if you switch your employer, you can move your defined contribution plan. So for instance, a lot of, so people who work at hospitals, okay, I think, so there is a municipal plan. And if you leave the hospital and you move to another, let's say, another job, let's say you become a teacher, you can move your plan into your new plan, or even under your own RRSP umbrella. You can oftentimes merge this plan. Defined benefit plans, you cannot. And then defined benefit plans are much more complicated. That's why you only start seeing it on government levels. And as an example, we say ABC Public Pension. So OMERS, the one, so Ontario teachers, and with the defined contribution plan, group RSPs or DPSP, those are the type of plans that you can get. Are there any questions about workplace plans? Because if there are, feel free to put it into chat. If there aren't, we're going to talk about a little bit about retirement planning. So by now, you can see the big picture. So the big picture is you get public plans, namely CPP, Canada Pension Plan, and Old Age Security. You get private plans, which is your RRSP. Oh, I didn't mention, this is fairly minor. On my list of private plans, you saw there is a RRSP RRIF, and then there is a LIRA and a LIF. LIRA is a locked-in RRSP. What's a locked-in RRSP? Imagine you have a group RRSP, and imagine you move to a new employer. So you remember we talked about portability of plans. You can take your RSP and move it, but your employer can lock it. When I say lock it, I mean they can restrict it. It's called a LIRA. So they can take your RSP and they can say you can move your RSP to yourself, but you cannot withdraw money from it up until the age of 65. So LIRA and LIF are very similar. Technically, they are RSP and RIF, except they're locked in from your employer. So back to the big picture, you got old age security and Canada Pension Plan, you got your RSP or LIRA, and then you have your group plan. Your group plan could be your defined benefit, defined contribution, or a group RSP, or a deferred profit sharing plan. So all of these are make up your pension, your future pension. So, and when we talk about your pension or when we talk about retirement planning, basically what we do is we run the numbers, and there are calculators that can help you do this. So imagine you come to me and you say, or you go to a financial planner, you go to your bank and you say, I am, let's say, 30 years of age today. I would like to retire at the age of 50. My parents retired at 65. I don't want to retire at 65. I want to retire at 50. So then the question becomes, there is a certain amount of money that you need to have at the age of 50 in order for you to live whatever your life expectancy happens to be. So if your life expectancy is, let's say, 90 or 95 or 100, you need to have more money. And these numbers, believe it or not, these numbers are very easy to calculate. Okay, and it takes literally just a couple of minutes to calculate these numbers. So then the question becomes, okay, let's say this magic number let's say the magic number happens to be 2 million. Let's say you need $2 million in a bank account at the age of retirement. And then from this 2 million, the money is going to grow at a certain rate. But then from this 2 million, you're going to withdraw a certain amount. Let's say, I don't know, $5,000 a month. Okay, and that $5,000 a month, given the inflation, given the interest that you're earning, or the investment return on your portfolio, that $5,000 a month will last you till, let's say, the age of 95. So these numbers are very easy to calculate. Ultimately, the question becomes, do you have $2 million in your bank account? Because if you do, great, you can retire today. And if, assuming you need $5,000 a month, and by the way, the numbers are random, and these are not. We can calculate the actual numbers, but these are just examples. What if you don't have 2 million? So then the question becomes, okay, how much money do you need to put aside today, over the next, if I'm 30 and I'm thinking of retiring at 50, I have 20 years, okay? How much money do I need to put over the next 240 months so that I have $2 million in my bank account at the age of 50? And then we look at certain assumptions. Well, how much interest could you get, or how much investment income could you get, et cetera, et cetera. And these numbers are also pretty easy to calculate. So retirement planning, in a nutshell, is actually very easy to calculate. It's not easy to achieve, but it's easy to calculate. And then the question becomes, okay, so let's just say I need $5,000 per month in retirement. Where is this $5,000 going to come from? Okay, well, we talked about CPP and old age security. Because I know, so let's say, if I'm 30 right now and I just moved to Canada at the age of 30 and I want to retire at 50, that basically means I have 20 years in Canada. So old age security, I can tell you right now how much old age security I would have based on these numbers. Okay, I can also estimate how much CPP you get. By the way, many of you may not know this, but each of you has a Service Canada account. So similar to how you have a CRA account, each of you has a Service Canada account where I believe you can take a look at how much CPP you would receive if you were to retire today. And so you can estimate this number, or you can get a more precise estimate from Service Canada. But ultimately, just by looking at CPP and OAS, you already know how much money you have. And let's just say you have $1,000 coming in between old age security and CPP. Great. So then the question is, well, how much money would you receive from your RSP or RRIF? And we know the percentage. We know the age that you're going to be, so we know how much money you would. So if you have $100,000 in your RSP and you want to retire at the age of 65, it's 4%. So if you have $100,000 in your RSP, then $4,000 per year is going to come into your account. So that's what, roughly, let's just say $300 a month. So now between your CPP, old age security, and your RSP, you already have roughly $1,400. Is that enough? Well, no, I need $5,000 a month. So where's the rest going to come from? And you might have a company pension, might be a DCPP, a defined contribution plan, defined benefit plan. You might have your own company. For many of our clients, or many clients who work with us, they have their own corporations, and oftentimes you can use your corporation in order to save money for your retirement inside your corporation. You might have money in your tax-free savings account. You might have rental properties, for instance. So ultimately, the question becomes, if you have all these buckets, so if out of these buckets you have $5,000 coming, then, and you only need $5,000 to live, great. Then potentially you can retire today. So it's not a very complicated calculation. And if you're thinking about this 20 years ahead, 30 years ahead, 15 years ahead, great. You got an advantage because you've got time. I remember I was taking a tax course, and I was sitting next to this lady, and she was taking the same tax course, and I asked why she was taking this tax course, and she said she's 65, she's just about to retire, she has nothing saved, so she actually needs a job. So she was taking this tax course because she needed a job. And it was really sad, because if she had this conversation with somebody 20 years prior, she would have had something. This is not a good investment strategy. When a person says, I do have a diversified retirement plan, 30% hopes, 30% wishes, and 40% prayers. And ultimately, with a calculator and with a few assumptions, you can know exactly how much you need. You can know how much to put aside. You can know what's the best way of getting there. You can also consider other factors. One very important one is taxation. How much tax are you going to pay? How do you minimize that? One important factor is called estate planning. If a person was to pass away, how much tax would their estate be paying on their holdings? So that is something that can be done, calculated very quickly and easily. And just a little bit about Schwartzman Financial. So we are a holistic financial management firm, and we do different services for our clients. We take care of people's retirement planning, take care of people's financial planning. We manage investments, we do taxes, bookkeeping, and we do webinars on different financial topics. And on the note of webinars, we have a couple of webinars coming up. We have one on July 16th called Investing 101, Building Your Investment Portfolio. Then we have one on August 13th for business owners called Financial Planning Strategies for Business Owners. If you'd like to connect with us, here is the information. And what we're going to do is we're going to open up the floor to different questions. If you do not have any questions, thank you for joining us. Feel free to let us know if there are other topics that might be of interest to you. And I do see one question. And the question is, what's my thought on RSP decumulation between ages of 60 and 70 before applying for CPP? Okay, and the second part of the question, will we receive this presentation as well? The answer is no, you're not going to receive the presentation. If you'd like a recording of this presentation, because this presentation is being recorded, I'm more than happy to share it with you. But to come back to the first question is my thoughts on RSP decumulation between ages of 60 and 70. So there is a strategy where if a person has a lot of money in their RSP, a lot, let's just say more than $500,000 in an RSP. Because when you think about it, let's say the person is 65, they have $500,000, so that's $20,000 a year that they're going to be withdrawing, and you're trying to minimize your income in retirement so that you end up paying less tax. So the question, or some of the strategy sometimes is, start taking money from an RSP. So don't actually convert RSP into a RRIF, but you can take money from an RSP, but there will be tax implications. And the tax implications are, there's a withholding tax, which depends on how much you withdraw. So to address the question, this is a very specific strategy. We do not generally recommend for people to do it unless they are in a certain situation. And if a person was to do it, then the question is, what's the alternative? Just as an example, one of the benefits of an RSP And this is a benefit that you only see in the long term. When I say long term, you don't see it for the first 5 years, 10 years, but after 15 years, after 20 years, you start seeing it. What's the benefit? The benefit of tax sheltering. So because you don't pay taxes, the growth starts really ramping up towards, 10-year mark, 15-year mark, 20-year mark. So taking the money out, then the question is, okay, let's say the person took $10,000 out of their RRSP and withholding tax plus additional tax payable on this 10,000 the year of the withdrawal. What are they going to do with this $10,000? And let's just say they put the $10,000 into a bank account. So then the growth on the $10,000 becomes taxable. So not only are there tax implications on withdrawal of the 10,000, but now, unless you use a tax-free savings account, you're paying taxes on the growth of it. It's not a really wise decision. But there are certain strategies that can be used. So for instance, withdrawing a smaller amount. For instance, if a person has a spouse, you can use the spouse's, if the spouse is younger, you can use the spouse's age for the RRIF percentage as opposed to the person's age. You can delay, okay? And ultimately, the more you delay, the more you accumulate, the more the investment grows. So the short answer to the question is it's not a black and white situation. Basically, it's, talk to your financial advisor, talk to your financial planner. Do we recommend decumulation? Have we done it? There have been a few instances where our clients have benefited from it, but generally the answer is no. Good question. Any other questions that you have? And as I mentioned before, I'm more than happy to share the recording with those who are interested, no problem. Thank you for joining us. Feel free to reach out if you have any other questions. You have my contact information there. And wishing everyone a fantastic rest of your afternoon. Thank you.